Hey people, I welcome you all to Caroline's Online Academy, and through this series of videos, we are learning the accounting for share capital through small concept problems. And today we're going to be looking at issue of shares at a premium. Now, let me explain what premium is before we start seeing how to account for issuing shares when shares are issued at a premium. Sometimes when established business houses or established companies issue shares, there is always a huge demand for those shares. For instance, when Zomato issued their shares, it was oversubscribed by 38 times. That's only one of the examples of many such instances. So assume Ratan Tata or the Tata group of companies start a new company, and if they issue shares, there will people will line up to buy those shares, subscribe to those shares, because they know that these people will make good use of the money that we are investing into their company, and they will be able to get nice returns for those money. Am I right? So when the established business also or the companies, any company that has a huge demand has always has the luxury of being able to issue its share above the face value of the share itself. Actually, any company can issue shares at premium, but practically speaking, only those companies that have those whose shares have a demand can issue shares at a premium, because only then people will subscribe. Issuing shares at a premium means a share is issued for a price more than its face value. For instance, there is a share of rupees with a face value of rupees 100 each. If it is issued for 105 rupees or 110 rupees or 120 rupees, the excess amount of money that is collected from the shareholders is called as the premium amount, and the share is said to have been issued at a premium. Assume a 100 rupee share has been issued at a premium of 120. Then the share is said to have been issued at a premium of 20 rupees or at 20 percentage. Oh, that is the percentage is on the face value. 100 rupee share is issued at a premium of 20 percentage, and 100 into 20 percentage will give you 20 rupees. That is the premium amount. Now, this premium that is collected from the shareholders can only be utilized for five purposes as stated by the Companies Act 2013. That is, this premium cannot be utilized like any other free reserve. Let's look at the five purposes for which a premium can be utilized. And this is very important from CBSE point of view, because a lot of times questions are asked from this. They might ask this as a 1 mark question or an objective type question, or sometimes as a 2 mark question or 3 mark question also. So you got to pay attention to this, and you have to remember this. Securities premium can be utilized only for the five purposes listed that you can see on the screen now. To issue fully paid bonus shares to the extent not exceeding the unissued share capital of the company. Basically, if the company has a certain amount of authorized capital, let's say 1 crore rupees, and it has issued 80 lakh rupees of shares already, the unissued capital is 20 lakh, right? To that much extent, the company can make use of the amount that is there in your securities premium to issue fully paid bonus shares. Or you might wonder what bonus shares are. Am I right? You might wonder what bonus shares are. Bonus shares are shares that are issued free of cost, like to the existing shareholders. Based on some proportion, the company will issue shares to them free of cost. The company actually can divide the amount of profits that it has using two different in two different ways. It can apportion the profits to the shareholders, right? The first is the company can, just give me 1 second, share the profits earned with the shareholders as dividend, or the company can give them out as bonus shares. Bonus shares means nothing but the company actually gives shares free of cost to the existing shareholders for this, for this moment. That much is enough. Now, the bonus shares be given as fully paid or partly paid bonus shares. For instance, if I am issuing a 10 rupee share for rupees 6 as a bonus share, then I've issued a partly paid bonus share, which means that the shareholder is supposed to pay 4 rupees on the share. 4 rupees is yet to be paid on the share. If I am issuing a 10 rupee share for as rupees 10 paid up, as rupees 10 paid up, when I'm issuing a fully paid bonus share. I'm issuing a 10 rupee share for as 10 rupees paid up. Okay. But in the earlier instance, I issued a 10 rupee share as rupees 6 paid up. Okay. Now, securities premium can be utilized to issue fully paid bonus shares. You cannot issue partly paid bonus shares, but you can issue fully paid bonus shares not exceeding the unissued capital of the company. That is first purpose. Second thing is it can be used to write off preliminary expenses of the company. Preliminary expenses are the expenses that are incurred by the company before the incorporation of the company, during the incorporation of the company. Understood? So that expenses has to be written off in the first year of operation, or first year of the company's operation. That is to say, assume a company came into being on 1st July 2023. The first year, financial year of operation then would be 2023 to 2024, and any expense incurred by the company before 1st July 2023 shall be written off in the year 2023-2024 itself. In that first year of financial year itself, it can be written off, and securities premium, if any is there, can be utilized to write off that expense. To write off expenses of or commission paid or discount allowed on any securities of the company. For instance, securities refers to your equity shares, preference shares, debentures, all of them are securities of the company. Assume you are issuing debentures of the company at a discounted price, like 100 rupee debenture has been issued for rupees 80. So you've given a discount of 20 rupees, right? That discount of 20 rupees is a loss for the company, and it can be set off using the securities premium that you have. That extra money that you collected and that profit is, you can set it off against that. To pay premium on the redemption of preference shares or debentures of the company. The company can pay premium on the redemption of the preference shares. When you have preference shares, you got to redeem the preference shares, and when you're redeeming in the sense, give the money back on the preference shares. When you issue the shares, you collected the money, right? And then after a point of time, with respect to preference shares in India, you have to redeem the preference shares. That is, the company has to give the money back and collect the shares back and cancel them. In India, understood, they are called as redeemable preference shares, and in India, companies can only issue redeemable preference shares. Sometimes when the company issue the preference shares, they say that when I issue the share, I tell my shareholders that when I am redeeming these shares, I'll give you a premium. For instance, a 100 rupee share, I'll redeem at 120. So if I say that I will redeem the shares at a premium, and when I'm redeeming the shares at a premium, I'm giving something extra, right? That is a loss for me, right? That loss I can set off against the securities premium reserve I have created. And the company can actually purchase its own shares. And the companies has a cash in abundance, and when they have reserves in abundance, and they have when they're making a lot of profit, the company sometimes decide to buy back their own shares. Companies can buy back their own shares from the existing shareholders proportionately, and for that purpose, the amount in securities premium reserve can be utilized. Understood or not, my dear children? Okay, fine. Now we know the 5 purposes for which we can utilize securities premium. I'm not going to explain it again, just like how I do it in class. And probably we'll do a separate video on the 5 purposes also in a more elaborate manner. But right now, what we're going to do is we're going to look at the question and understand how to account for issuing shares at a premium, when we issue shares at a premium. Okay. So let me read the question out aloud for you. Divyashree Limited issued 1 lakh shares, rupees 100 each at a premium of 20%, payable as follows. Application rupees 25, allotment 40, which includes the premium amount of 20 rupees also. And first call is 20, second call is remaining. The company received 1 lakh applications and allotted in full. We have to pass the necessary journal entries. Now let's first find out the amount that is supposed to be collected along with first call. We know that the issue price of the share is 120. Now, how did we know that? The first line of the question says that Divyashree Limited issued 1 lakh shares of rupees 100 each at a premium of 20%, which means 20% is being collected as premium. 20% on 100 is 20% into 100 will give you 20 rupees. Correct. So 100 rupees plus the 20 rupees premium is what we are collecting, and the total amount collected then therefore is 120. And on application we are receiving 25. Along with allotment, we are receiving 40, and along with first call, we are receiving 20. So we have received 85 with application, allotment, and first call. So the amount receivable on second call would be 35 rupees. Second and final call would be 35 rupees. Let's go ahead and account for this. The first journal entry, as you all already know very well through the previous videos that we have, that we have taught, it's bank account debit to equity share application account, not equity share capital, it's equity share application account. And the amount would be number of applications received into application money per share. Application money received, and that will be, my dear children, 1 lakh is the number of applications received into 25 application money of 25 rupees. Okay. The second journal entry, in case we reject any shares, we need to refund the application money on the rejected shares. But fortunately, in this question, we are not rejecting anything. We just have to allot the shares and make the allotment money due. When we allot the shares, the first transaction would be to transfer the application money to share capital account, application account debit to equity share capital account, shares allotted, and that will be 25 lakhs that we had received as application money, and we need to make the allotment money due. This is where it actually changes, my dear children. The journal entry slightly changes when there is premium. In whichever call premium is due, when you account for that, it is slightly different from what you have learned till now. Okay, so equity share allotment account debit, you make the allotment money due completely. So that is 40 rupees is the allotment money per share, including the premium of 20 rupees, right? So 40 rupees you make due. 40 into 1 lakh is 40 lakh rupees to equity share capital. Only the capital portion shall go to equity share capital account. Now, out of the 40 rupees, the 40 rupees made due on allotment includes the premium of 20 rupees. So, remaining 20 rupees only is a capital portion, right? So, 20 into 1 lakh will go to equity share capital account, and the remaining 20s as it is premium shall go to securities premium account, and the balance in this account can only be utilized for the purposes, 5 purposes that we studied earlier. Understood or not, my dear children? The journal entry narration would be allotment money made due. Everything else is same, my dear children. You receive the allotment money, you receive whatever you made due. So bank account debit to equity share allotment account. You made due 40 lakh, you receive the 40 lakhs, and then you make due the first call money and you receive it, and make due the second call money and receive it. Share allotment money received. As the numbers are the same, I'm just going to copy the first call and second call from the previous problem because I don't want to waste your time. Okay, numbers are not exactly same. Our problem was under subscription. The journal entries are same. So if you see, right, so this will be 1 lakh into 20, and this will be 1 lakh into 35. The other things are same. Making the allotment money due, first call due, everything is same. Making second call due, receiving second call money. Only whenever premium is involved, in the call in which the premium is involved, the premium portion of that, when you make it due, the premium portion of that call shall be credited to an account called securities premium account, which will only be utilized for the 5 purposes listed in the Companies Act 2013. To issue fully paid bonus shares to the extent not exceeding the unissued share capital of the company, to write off preliminary expenses, to write off or commission paid, or expenses of or commission paid or discount allowed on any securities of the company, to pay premium on the redemption of preference shares or debentures of the company, and to purchase its own shares. Alright children, so with this we have come to the end of this video, and we'll be doing a couple of more problems on premium, with premium receivable on 2 different calls and stuff. So kindly keep following, and yeah, as this is YouTube, I want to tell you, please subscribe, share with your friends who's preparing for board examination, and like and comment. That helps with the YouTube algorithm for more people to find this content, which might prove to be useful for them. People take care and have fun. See you again in the next video.